Hello everyone, welcome back to my YouTube channel IB Made Easy by Garima Chhabra. This is the third part of first chapter of Microeconomics. Let's start. The first topic that we are going to discuss today is business cycle. What happens in an economy? There are various levels of business economic activities. An economy goes through various levels of economic activities. Sometimes economic activities are at peak, sometimes they decrease, sometimes they increase. What are economic activities? Economic activities are the activities of consumption, distribution, production. When all these activities go through different phases over time, these phases are shown by business cycle. So business cycle describes us the fluctuations in the level of economic activity in a country over time. In the short run, we have different phases: boom, peak, recession, slump, recovery. First of all, peak. What is peak? This point. Peak is that point in business cycle where economic activities are at its highest level. When the production, consumption, distribution, all these activities are at the highest level. Since the economic activities are at highest level, unemployment will be lowest and business and consumer confidence will be high since economy is doing good. Then we have recession phase, this part when it is decreasing. What is decreasing? Economic activities. Recession is a phase in the business cycle that occurs when there is fall in the domestic product for 2 consecutive quarters. We call it recession when GDP, because of the decline in the economic activity, GDP declines for consecutive 2 quarters. That means 3 plus 3, 6 months. Then is slump, lowest part. A slump, or also known as trough. Trough is a phase where the economic activities are at its lowest. Since economic activities are at its lowest, economic growth declines, business starts to close, and there is cyclical unemployment. What is cyclical unemployment? Decrease in the aggregate demand leading to unemployment. It is known as cyclical unemployment. Now, since these are for a shorter period of time, economy comes back to the situation. When it goes back to its normal situation, this part is recovery. Recovery is the part where GDP starts to grow. GDP starts to rise after trough in the business cycle, leading to the increased economic growth. Here economic growth increases, and since economic growth is increasing, employment opportunities also increase. Then we have boom part, this part. Boom is a phase of business cycle where level of economic activities rise caused by the increase in the aggregate demand. But here, since aggregate demand is increasing, it leads to increase in the general prices as well. These are the short-term fluctuations. In the long run, we call the direction as trend. It shows the level of potential output, that is highest level of GDP that can be sustained over long run. What is potential output? It refers to the possible level of real GDP that can be achieved, shown on its production possibility curve if all the resources are used efficiently. When we talk about PPC, any point on PPC, which shows that all our resources are fully utilized. It is our potential output. Now, since we discussed in our previous videos about the use of GDP or GNI to measure the economic well-being, the question arises, is it appropriate to use GDP or GNI as measure of economic well-being? So here we have to tell the pros and cons of GDP or GNI. The pro, what are the benefits of using GDP? First of all, it compare economic well-being over time. Same country, different years. We compare the economic well-being. Then same year, different countries. We can compare the economic well-being of different countries at the same time as well. It shows if the GDP per capita is higher, then there is higher standard of living. So we can measure the standard of living of different countries as well. Then, what are the limitations of using GDP or GNI? First of all, it does not show whether the income in the country is distributed equally or unequally. Then it does not show the varying different rate of direct and indirect taxes charged by the government of different countries. We cannot compare this with the help of GDP or GNI. It does not show the cost of living of different countries. We cannot compare countries on those bases. Also, we can compare two countries, but international comparison is meaningless because of the fluctuations in the exchange rate. When exchange rates changes, at that time the international comparison become meaningless. It also does not tell about the social welfare benefits that are given by the government to the people. It also does not reveal the composition of national output. Composition of national output means what kind of goods are produced in the economy, whether capital goods or consumer goods are prepared, whether government is spending on education or healthcare, or it is producing defense goods. Also, it does not reveal the true picture because of the shadow economy. Shadow economy means there are some economic activities which are not recorded in the data, which are not properly counted in the books of the government. So the actual data is not revealed because of hidden or shadow economy. Also, since economic growth is happening in a country, it also leads to negative externalities. Negative externalities means negative impacts either on environment or on third party. So it does not tell us about the negative externalities that are caused by the production of national output. All these are the limitations of using GDP or GNI as a measure of economic well-being. In the last point, we discussed about the negative externalities. But how do we calculate external cost? External cost is basically the cost to the third party which is not involved in your transaction. So we calculate green GDP to calculate the external cost. And the formula for green GDP is nominal GDP minus environmental production cost. Any cost that is done to the environment, any negative impact on environment. And this formula is made assuming that we can calculate this cost exactly, the impact that production has on the environment. We can calculate it completely and accurately. This formula is based on this assumption. So green GDP, it is nominal GDP minus environmental production cost. What does green GDP shows? It shows the value of output considering all the environmental degradation, damage, and destructions that are associated with that economic growth, with that production. Now, because of all the limitations that we have read of the GDP or GNI, we have other measures as well. We will discuss alternative measures of well-being now. First is OECD Better Life Index. It was launched by Organization for Economic Cooperation and Development. It is based on 11 topics. 1 to 3 topics are basically material living conditions, and 4th to 11th talk about the quality of life. These 1 to 11 are not ranked in a particular order. These are housing, what are the housing conditions and expenditure of the households, income, what are their disposable income, net financial wealth, what are their earnings, job security, employment, community, their social support, their social network. Then we have quality of education, then environment, quality of environment that they have, governance, whether they are involved in democracy or not, then health, quality of health care, life satisfaction, happiness level, safety, crimes are there in the society or not, then work life balance, hours of work versus hours of free time basically. Now the limitations of BLI is that it has only 35 members. So the comparison of all the countries, that is international comparison, becomes difficult. Another measure that we have is happiness index. It was created by UN Sustainable Development Solution Network. It uses 14 indicators: business and economic, citizen engagement, communications and technology, diversity, education and families, emotional well-being, environment and energy, food, shelter, government politics, law and order, health, religion and ethics, transportation and work. You can just go through these. Now the strength is that these 14 are updated time to time as per the need of the situation. But the limitation is it makes historical comparison difficult, because since these factors are updated with time, the comparison with the previous factors become difficult. Then we have Happy Planet Index. It was introduced by New Economics Foundation. It considers both current and future prosperity of individual and society. It has focus on the importance of happiness, health, sustainable life, but without impacting the planet. So the formula for calculating this is well-being into life expectancy into inequality divided by ecological footprints. Since it includes all the things, happiness, health and sustainable lives, but without impacting the ecological environmental factors. So ecological footprint is taken in division. What does all these four means? Well-being means on a scale of 0, which is worse, to 10, which is best, how citizens feel about their own life overall. Then we have like life expectancy, which means what is the average number of years a person is expected to live in a country. Then we have inequality of outcomes. It measures inequality of people within a country in terms of how long they live and how happy they feel, expressed as a percentage. So we measure the inequality of the happiness and the life of the people. Then we have ecological footprint. It measures the impact that average person, that means one person in the country, has on the environment. It is expressed in terms of global hectares, GHA, per person. All these were the measures, alternative measures of economic growth. Thank you for watching this video. Let me know your doubts and the topics that you want me to discuss in the comment section. Like, share and subscribe to see more such videos.